If you want to know why oil, petrol, and electricity bills might get ugly, look at one place, the Strait of Hormuz. It's a narrow bit of water, but it controls a stupid amount of global energy. And right now, because of the US-Israel war with Iran, this choke point is being squeezed hard. The fighting started on February 28, 2026, and since then shipping through Hormuz has been crushed. The International Energy Agency says exports through the strait are now under 10% of pre-war levels. That's not a small disruption. That's basically the market getting punched in the face. Oil prices reacted immediately. Brent is trading around $100 a barrel today, and earlier this week it hit about $119.50. That's the highest since mid-2022. Here's why Hormuz matters. The U.S. Energy Information Administration estimates that in 2024, about 20 million barrels per day flowed through Hormuz, around 20% of global petroleum liquids consumption. And roughly one-fifth of global LNG trade also goes through there, mainly from Qatar. The IEA says in 2025, roughly 20 million barrels per day of crude and oil products moved via Hormuz, about a quarter of the world's seaborne oil trade. So when this lane is blocked, the market doesn't just lose Iranian oil. It risks losing the whole Gulf export machine. Now, people think the issue is, do we have oil in the ground? Wrong. The issue is, can you move it safely? Reuters reports war risk insurance premiums have risen by more than 1,000% in some cases. That's insurers basically saying, this is madness, pay up. And even if you pay, ship owners still don't want crews killed. So tankers sit, trade slows, and prices spike. We're already seeing production shut-ins. Saudi output has reportedly dropped to around 8 million barrels per day, and the IEA estimates Gulf producers have cut at least 10 million barrels per day because shipping is blocked. JP Morgan says the disruption could push supply cuts toward 12 million barrels per day soon, and warns about shortages not just in crude, but in diesel and jet fuel and other refined products. On the gas side, Reuters reported Asia's LNG price marker jumped to $25.393 per MMBTU, while Northwest Europe rose to $15.479. Wood Mackenzie estimates about 19% of global LNG exports are effectively tied up by the closure risk. Okay, let's do this in 4 checkpoints. Next 1 month. If the strait stays heavily constrained, expect oil to stay high and jumpy. A base case is Brent roughly $95 to $125. If things get worse, more tanker damage, more mines, then prices can spike much higher. Iranian officials have talked about $200 oil as a threat. Gas and LNG remain tight in the short run because you can't instantly replace Qatar cargoes. Next 3 months. This is where the path splits. If there's a de-escalation and escorted shipping resumes, prices can cool. Goldman even expects Brent around $85 in April if things calm down. But if Hormuz remains constrained for 2 months, Goldman's own scenario has the market ending the year at higher levels, with Q4 average Brent closer to $93 instead of $71. That's a big difference. Also, even if the strait reopens, it's not instant. Reuters notes Kepler's estimate that it could take 6 to 7 weeks for Gulf exports to return to full capacity after a reopening. So, the aftershock lasts. Next 6 months. By 6 months, the world starts adjusting. Refiners run harder where they can. Some demand gets destroyed because prices get too high, and non-Gulf supply tries to fill gaps. But there's a catch. If infrastructure damage is real, ports, fields, refineries, then the war premium sticks and you don't go back to normal prices quickly. Next, 12 months. A year out, it becomes less about today's tanker drama and more about the lasting consequences. If the conflict settles and shipping risk fades, a normalizing path could put Brent back in a $65 to $85 kind of world. If the region stays unstable, you can get a permanent risk premium. Oil prices not constantly at $150, but consistently higher than they should be, because traders keep pricing in the next disruption. Now the pain spreads. In the US, Reuters reported average regular petrol is already around $3.32 a gallon, up 11% in a week. Diesel $4.33, up 15%. And analysts warned petrol could push toward $3.50 to $3.70 if oil stays high. Diesel and jet fuel are especially sensitive because they are tied to refinery capacity and global product trade. JP Morgan explicitly flagged shortages in diesel and jet fuel and other products because approximately 5 million barrels per day of refined products normally transit Hormuz. In Europe, higher gas and LNG prices flow quickly into electricity prices. In the UK, Cornwall Insight forecasts the household energy price cap could rise about 11% in July, and Reuters notes wholesale gas prices rose over 60% in 2 weeks, partly because Qatari LNG exports were disrupted. And yes, this feeds inflation. Higher energy means higher transport costs, higher food costs, and central banks become more cautious. Reuters explicitly linked market moves to inflation fears and weaker growth concerns. Governments are not sitting still. The IEA has agreed a record 400 million barrel release from emergency reserves, and members hold over 1.2 billion barrels of emergency stocks, plus additional industry stocks under obligation. Reuters also reports the U.S. Energy Secretary said the U.S. will release 172 million barrels from the Strategic Petroleum Reserve starting next week. That's a combined 572 million barrels, but it's still not a magic wand if Hormuz stays shut. On OPEC Plus agreed only a 206,000 barrels per day output increase for April, tiny versus the scale of what's being disrupted, and analysts warn shipping has to function for extra oil to matter. And then there's sanctions. The U.S. Treasury issued General License 134, allowing the delivery and sale/offloading of Russian-origin crude and petroleum products already loaded on ships as of March 12th, authorized through April 11th, 2026. Basically a short-term pressure valve to get oil moving. Here's the simple takeaway. If Hormuz stays constrained, oil and gas prices stay high. Maybe not every day at $150, but high enough to keep petrol, diesel, shipping, and inflation under pressure. If shipping reopens and stays open, prices can cool faster than people think. But the risk premium won't vanish overnight. In this war, the energy market is watching one thing. Can tankers sail safely, at scale, and for weeks in a row?